is the capital structure. What is the optimum capital structure or OCS? It is the proportion of equity and debt a company adopts to maximize its wealth and market value and minimize its cost of capital. Thus, it is calibrated to balance the company's worth and its cost. So, in simple words, optimal capital structure is figuring out the perfect mix to make a company the best it can be. It means finding the right balance between borrowing and sharing. So, if you borrow too much, you might have trouble paying it back. If you share too much, you'll have to share all the money you make. So, optimal capital structure helps you make the most money while managing the risk of borrowing. We have here a figure. So, on the top, it defines optimum capital structure as the ideal blend of debt and equity that will maximize a firm's value while minimizing its cost of capital. So, the capital structure box represents the choices a company has in financing. They have the equity, which is the money from shareholders or owner, and debt, which is the borrowed money or loans. In the center, it shows optimize, meaning the company needs to find the right balance between equity and debt. So once the optimum capital structure is achieved, it leads to two main benefits. First, maximizes firm value. The company becomes more valuable to investors. And lastly, we have minimizes cost of capital, which is the overall financing cost is being reduced, making the company more efficient. So there are various determinants of optimum or optimal capital structure that leave a significant impact on the operations and management of the organization. So let us understand some of its determinants along with their importance. First, we have the cost of capital, which is every penny invested in a company is a cost. Therefore, a company must be able to return the finance provided by suppliers. A good example for this one is if a company can borrow at 6% interest while equity investors demand a 12% return, the company will prefer more debt since it's cheaper, unless debt becomes too risky. Two, sales growth, profitability, and stability. The company is earning well in the market. It goes without saying that if the company is earning well in the market, has a customer base, and has a constant demand for its product and services, its goodwill ensures a smooth business run. At the same time, low sales and growth can create a vice versa situation with higher risk and debt issues. So, sales and development enable the company to deal with debt and interest repayments. So, hence, it is vital in determining capital structure. A good example for this one is a tech startup with rising sales and stable demand can take on debt confidently, while a company with declining sales may struggle to repay loans. Next, we have the cash flow, the ability to generate cash flow. The ability to generate cash flow plays an essential role in attaining optimum structure. Conserving the cash flow and predicting future requirements and shortages can help a company create a lower debt or preference capital structure. Thus, the predictability and variability of cash flow are crucial determinants of capital structure. An example for this one is a retail store with steady monthly cash inflows from sales can easily handle loan repayments, but a seasonal business like Christmas shop may struggle with debt. 4. Company size. In the early stages of business, a small company may find it challenging to raise the required capital. Alternately, a well-established company can easily obtain any amount of equity or debt. Therefore, a company's size or stage has significant consequences on capital structure. An example for this is a small family business may find it hard to secure big loans, but a large company like SM or Ayala Corporation can easily raise both equity and debt due to strong reputation. Next, we have the risk. Every business assumes, anticipates, and struggles with risks in operations and management. So, when a company designs an optimum capital structure, it usually becomes across two types of risk factors, which are business risk and financial risks. So, business risk is directly related to the change in the company's earnings, demand, supply, income, and revenue generation. In contrast, financial risk refers to the market changes, substitutes available, or entry of new competition, typically not in control of the company. So, the company's strength to overcome all types of risk impacts its overall capital structure. An example for this is a company selling luxury goods has high business risk if customer demands falls. So if it also takes large loans, it faces financial risk from paying interest during low sales. And lastly, we have the market conditions. Market conditions are dynamic. So a firm can never work in an active market with a static and old measures and business ways. The market sometimes faces recession and at other times rides high on massive boom. Hence, a company must optimize its capital structure to remain stable and relevant. A good example for this one is during a recession. Companies may avoid taking on more debt, but in boom period, they may borrow more to expand quickly. So, in conclusion, business and financial risks in a company are like the challenges and uncertainties we face. Business risk is familiar or is similar to misunderstandings or changes in life that test the bond, while financial risk is like the pressure of responsibilities and commitments. So, finding the optimal capital structure is like finding balance in life. Too much dependence or too much independence can cause problems, but the right mix creates stability, growth, and lasting happiness. Now, to end my presentation, I would like to present a video presentation. Let's watch this.
Risk can be scary for a management team. There are many types of risks for a business, but they can be divided into two main categories: financial and business risk. Financial risk emerges for a firm when debt represents a larger proportion of its capital structure. Under these circumstances, principal and interest obligations, coupled with onerous covenants and reporting, may force the company into an event of default. Business risk, on the other hand, is a broad category representing all other internal and external forces that may converge to threaten a company or its management team's ability to operate. Threats include forces in the external business environment, including macroeconomic factors like inflation and FX rates, as well as technological trends that might disrupt a business or its supply chain. Industry-specific risks, including regulation, barriers to entry, or a declining total addressable market, and company or firm-level issues, including weak performance ratios, high employee turnover, and customer or supplier concentration, among others. Early in a firm's life cycle, business risk is high. Product market fit is unknown, the business model may be largely unproven, and the total addressable market may not yet be established. Early-stage companies are generally equity funded for this reason. As a result, financial risk is very low, since debt is typically not available. As a company matures through the life cycle stages, however, and some of these early questions get answered, business risk decreases and financial risks tend to increase, since many management teams take on debt to support growth and operations. Tools used to help assess and quantify business risk include, but are certainly not limited to, the Pestel framework, Porter's 5 forces, and SWOT analysis.
If you can think critically and do grade school math, you can understand finance. Here are 2 more important ideas in finance. Cash only comes from 3 places: operations, debt, or equity. And risk goes down in chunks. Remember that financial engine we drew for the lemonade stand? We put cash in the gas tank. We bought lemon, sugar, and water for the factory. We turned all that into lemonade and we sold it. Hopefully, we had excess cash at the bottom of the sales funnel to start the cycle all over again. But to start that engine in the very first place, we probably needed to get outside cash into the tank. Now, there's only 2 ways to do this: borrow money or sell equity in the business. There are a lot of variations on debt and equity, but don't let it confuse you. Debt is just a promise to repay someone at a particular date and at a particular price. The price is usually expressed as an interest rate. Sometimes you repay that money in cash, and sometimes you repay it in ownership, as in the case of convertible debt. The other way to put cash in the gas tank is equity. Equity gives the investor a percentage ownership in the business. They only get paid if there's a dividend or if they sell their shares. So it's riskier than debt, and therefore the investor expects a higher return. The 2 basic forms of equity are common stock and preferred stock. Common stock is where you sell a piece of the company to an investor at a negotiated price. Here, the shareholders are all treated equally in a liquidation. Preferred stock is where you sell a piece of the company to investors at a higher price in exchange for letting them get paid first in the event of a liquidation. That's the preferred part. Let's go back to the gas tank, the factory, and the sales funnel. Once this engine is up and running, hopefully it starts to put cash back into the gas tank. This is cash from operations. But remember, if you grow assets, sales, or expenses faster than you grow cash from operations, you have to raise money from outside the company. The other important idea is that risk goes down in chunks. You can think of a new business as a stack of risks, represented as a bunch of life or death questions. Before we opened that lemonade stand, there were a lot of these questions. Can we even make lemonade? Will anybody buy it? How much will they pay? After we ran the lemonade stand for a while, we answered those questions and we reduced the risk by a lot. But the list of questions is way longer than that. And if we keep going in the lemonade business, we're going to have to answer those questions too. And we'll probably answer them in big chunks. For example, can we advertise to increase sales? Can we improve our profit margin? Are we better at lemonade than our competitors? Now, why does any of this matter? Because it helps founders decide when to raise money and how much to raise. If you can estimate how much gas you need in the tank to start the engine, and if you know how long you need to run the engine to reduce big chunks of risk, that tells you how much cash you need and roughly when to put it into the business. And depending on the situation, you can raise cash from operations, from debt, or from equity, aligning your financial strategy and your risk reduction strategy.
And that would be all for business risk versus financial risk and optimal capital structure. Thank you for listening.